Wouldn't it be nice if you could know everything that will be happening in the financial markets beforehand? Well, at Visual Sectors, we don't have a crystal ball to tell you the future, but we have data and some pretty good experts. We looked at 10 big banks' outlooks for 2024 for you and found out what they missed. So to help you see clearer what 2024 might have in stock for us, let's look at our data. By the way, if you're new here, I am Josh with Visual Sectors, and our goal is to gather data and help you use it to make better investment decisions. Let's start with a look at economic growth. The COVID cycle has impacted the economy, and measures have been taken by governments, shaking everything we know. So are we looking at a soft landing or a market crash? First of all, the Fed indicated 3 rate cuts in 2024, while the market was pricing at 6. As of last week, markets have corrected to now indicate the same rate cut. That was a pretty big discrepancy. We can see some kind of loop effect happening caused by shelter inflation and the weather effect, which could cause rates to remain higher than markets are expecting coming into this year. Let's look at 2 factors. First, the PCE, a rate closely monitored by the Fed. At the end of 2023, the cost of shelter made up more than 40% of core CPI and 15% of core PCE compared to 2019. We can see an increase in housing costs by 20% compared to those pre-pandemic. But if we look closer, the situation is even more critical. From October 26th to December 28th, the average 30-year fixed-rate mortgage in the US fell from 7.79% to 6.61%, while the housing inventory fell 11%. That's a lot of demand for a very limited supply. If lower rates happen, they will lead to a higher housing affordability component of CPI and PCE, which could lead to a slowing of future rate cuts. BNP Paribas and Fidelity highlight the potential depletion of excess consumer savings. Excess consumer savings are the primary driver of consumer spending patterns, and this factor could have significant implications for the US economy. However, looking at those data, we believe markets and banks are far too dovish on rates. Another key metric to look at, the unemployment rate. We could dedicate an entire video to this topic. So far, unemployment remains low and has not been negatively affected by higher rates. But there have also been a lot of measures post-COVID to help businesses that need to be removed to assess objectively that rate. The Inflation Reduction Act, put in place by the US government, has also given a lot of fiscal support from infrastructure spending and low energy costs. Those measures created an illusion of economic recovery that has yet to be shown sustainable. On the other hand, a new economy is emerging, possibly changing the future. For that, I will let our Wall Street veteran Brian Tancock tell us what he thinks we are going to see in the near future.
Like it or not, the dawn of the AI age is here, and it's reshaping the way people work. We're already seeing large numbers of corporate layoffs, humanoid robots are being used in warehouses by Amazon, and militaries are deploying AI systems in battlefields to perform and execute tasks previously done by analysts. The job market is starting to look more and more like a Black Mirror episode. For the overall economy, however, this latest disruption will create challenges. The last time we saw something similar to this was in the early 2000s with the democratization of the internet. At that time, the labor force participation rate went from 67.5% down to 66%, before falling all the way to 63% after the financial crisis. Currently, we're still in the process of recovering all the jobs lost during the COVID recession, and AI is drastically changing the job market in some industries altogether. I do think that as we see AI-related technologies evolve, we could possibly see a bigger disruption to the labor force than we had during COVID, the Great Recession, and the birth of the internet age all combined. So, while AI will continue to generate wealth for asset owners, workers, on the other hand, are going to have to adapt to a new landscape where there are fewer opportunities that require higher and higher levels of skill.
Thank you, Brian. While we can see the direct impact of the democratization of AI, we have yet to see the full scope of usage and its impact on the economy. While looking at the US economy is always the best starting point to understand the US financial market, we also need to look at the rest of the world. A lot of elements are moving on the geopolitical chessboard, and banks are very cautious about it. 2024 will be a year of political changes, with 25 presidential elections planned around the world. Both Morgan Stanley and Fidelity anticipate a challenging landscape for investors, with both opportunities and risks. And while Morgan Stanley highlights opportunities on fixed income, Fidelity challenges the market's optimism under a soft landing scenario, citing pressure on companies' labor costs, geopolitical tensions, and the demands of the energy transition. Goldman Sachs, however, stands out for its bullish outlook, emphasizing positive economic indicators, limited recession risk, and anticipated tailwinds for global growth. However, the outlook might have underplayed the rising geopolitical risks. So far, 2024 saw the recent election of a pro-sovereign president in Taiwan, in the face of China's calls for reunification. The disruption of the Taiwan Strait would cut off half the world's shipping, impacting global commerce in an unprecedented way. While the risk of war between China and Taiwan is still relatively low, analysts predict the economic costs of it could be far greater than COVID. Factored into the economy, the expected value is not insignificant. We think that global outlook could have underplayed the geopolitical risks as the peace dividend of the last 50 years may be going away. But how could those geopolitical events impact the US markets?
Geopolitical risks are a landmine for the markets at this point. The world is currently experiencing two armed conflicts, one in the Middle East and the ongoing war between Russia and Ukraine. We've already seen how disruptions in grain shipping from Ukraine can inflate food prices on a global scale. Well, that would be nothing compared to the effects on the global economy if China and Taiwan were to engage in a war. Thankfully, we think the likelihood of this happening is still relatively low, but the economic and human consequences would be so great if it did that we have to keep an eye on it. The global economy is at an inflection point right now, as China is seeing its economic influence wane. The country is in serious jeopardy of falling into a deflationary recession that could last decades, very similar to what Japan went through in the late 1980s and is just now fully emerging from. In its place, other emerging markets are gaining influence, namely India and Mexico. And the rise of the Mexican economy has been hugely beneficial to US companies who've been able to relocate their supply chains to be geographically closer and be less reliant on a part of the world that may become politically unstable. Unfortunately for Europe, so much of their economy had been centered around Chinese consumption for the last 15 years that they're now having to find new avenues for growth going forward. With all of that being said, I would most closely align my forecast for this year's global growth with Goldman's outlook for better than expected economic and market performance. I think the US is well positioned relative to the rest of the world given its independent energy and industrial production, and it should be able to continue to monetize gains from being rich in natural resources and capturing technical evolutions.
So, what does all this information mean for the US market? Are we finally in the bullish market everybody hopes, or are we doomed to stay in a bear market? Well, it could be a little bit of both. The consensus is that the US economy is recovering and going stronger, but on a weaker path than pre-COVID. So let's look at what banks are recommending to us. Such unprecedented times should call for unprecedented strategies. And BlackRock encourages investors to move away from a traditional cyclical playbook to adapt to our new reality. Morgan Stanley and B of A recommended balanced approaches to the year, with anticipated lower rates providing a tailwind to high-quality fixed income securities like governments, agency, and mortgage debt, in addition to investment-grade corporates. Vanguard's research suggests a substantial increase in bond return expectations, presenting a positive outlook for bond portfolios. Long-term investors in balanced portfolios are positioned for a higher probability of achieving a 10-year annualized return of at least 7%. Brian, what's your position on this?
As we're talking right now, markets are sitting at all-time highs, with the S&P trading above 5,100, and everything's looking pretty rosy. I will say, though, that equities are technically and fundamentally overextended at this point, and the upcoming presidential election could also potentially move markets, but I think perhaps less so than 2020 and certainly less than 2016. So there are some landmines for investors to weigh. Given that, I think it's a great time for investors to take advantage of high fixed income yields. We're seeing short duration strategy ETFs for investment grade and high yield bonds paying close to 5 and 9% respectively in dividends. I especially like the short duration aspect of this because it reduces sensitivity to changes in interest rates, because at this point I think there's still a lot of uncertainty around the future of rates. Especially if assets like equities and residential real estate continue to boom, we may not get the future interest rate cuts that everyone's expecting. But be aware of other risks like the maturity and fiscal cliffs. As debt is refinanced at higher rates, smaller companies will have their ability to innovate constrained, and more of the US budget will have to be committed to debt service, which could potentially reignite inflation. We're also starting to see warning signs from the consumer, as credit card delinquencies are rising and credit scores are falling. A weak US consumer would be bad for financial markets and the economy. And then there's the commercial real estate conundrum, which is causing problems for regional banks. These banks hold a lot of that debt, which is quickly becoming non-performing. How much will they have to write off, and will they be able to survive? Overall, I remain bullish for equity markets, especially given recent technical innovations. However, I don't foresee a year of low volatility, steady returns.
Interesting. We can also see the equity markets go one of two ways. A market correction brought by stretched valuations and a higher than expected rate environment, or a high growth environment similar to the dot-com bubble inflation driven by investment opportunities and FOMO. Either way, we can expect higher levels of market volatility in 2024 than we had in 2023 as a result. As we are living in a period of change, we have no certainty about the future. But despite the illusion of factors impacting the economy from every side, and the fear it generated amongst investors, we can also see some positive signs. The liquidity risk is perhaps the worst kind of tail risk factor, as we saw in 2008, but we don't think it will affect the present. The rolling over of high-yield corporate debt, low long-term treasury demand, and heavy public debt can also be seen as credit risks. While we agree the closing of the Treasury reverse repo window will change the market dynamics, we can also see banks as having record amounts of cash as a buffer to any lending and rate impacts. The fact that China just decreased its banking reserve requirements is a new liquidity risk factor that we see as it, effectively, increases leverage in the country's banking system, which could possibly lead to systemic events similar to SVB and Credit Suisse, but on a much larger scale. The biggest issue with liquidity is that it's like an earthquake or tornado. There's little warning, and the damage done happens quickly and is severe, so it's always something that needs to be monitored. So what else could we say about the year to come? Well, we looked at our sentiment indicator at visualsectors.com and saw a limited upside in the first half of the year. By June, the SPY is expected to reach $525, but December and January bets look less impressive, with a probable pullback into the $420 to $435 area. But bear in mind, a huge hedge at $410 SPY price level. Even if it's too low to be a realistic target, it shows us the level of uncertainty options traders have amid this strong bullish run. In conclusion, here is what we can say. Yes, markets are finally transitioning out of the pandemic cycle and are at an inflection point. Yes, we could come close to a dot-com style bubble burst. Yes, the geopolitical aspect of the world brings more uncertainty than ever. But also, no, the markets are not crashing down. Markets and economies are in a state of transition and are evolving right before our eyes. Financial opportunities arise every day, and it could lead to new unforeseen growth. However, with so many factors to take into consideration, it's very important to make informed decisions and to apply a precautionary approach. At Visual Sectors, we are determined to help you in that process by providing you daily data. Right now, you can benefit from a 7-day trial in our platform and see for yourself. And if you want daily financial news and opinions on stocks, follow us on Instagram. We're posting twice a day. All the links are in the description. Next week, we will talk about the usage of unemployment data in your stock research. So, subscribe. You don't want to miss it. See you next time.